Bob the Bear has nailed it again. When Nomura's Bob Janjuah was last on the Inside Track about 6 weeks ago, he called for a spring pullback on the S&P 500 down into the high 1200s. And that's exactly what happened. The S&P 500 hit 1295 on May 18th, down almost 10% from its April high of 1419 before staging a modest recovery. It was just one of Bob's many spot-on predictions. Nomura's global head of tactical asset allocation is back with us this morning from London. Bob, good morning.
Hi, Eric. How you doing?
Doing well. Let's stick with a stock story, Bob. You nailed it pretty much, 9%, almost 10%. Pretty close to what you said was going to happen. We have seen, as I say, the S&P 500 stage a modest recovery. What happens next?
Yeah, well, look, I mean, first of all, I guess it was nice to be right after getting Q1 so wrong, so that's a good thing. I think from here, my overall directional view on a sort of 2-month view from here through June and July is that we get a phase of risk on, driven by policy. But I do think it's going to be choppy, and I'm not 100% convinced that we've seen the bottom in the sell-off. We may have a bit of a double bottom. We'll be trying to attack 1280 again. But net on a 2-month basis, I'm looking for a bit of risk on here.
Okay, so we're at 1332 right now, using the S&P 500 as a proxy for risk. Where do you think it could go at the high of this risk-on trade?
Look, I think if we get the stars aligning perfectly in Greece, policymaker talk from the Fed, some talk perhaps on the fiscal story in the US, and of course in China, we could see stocks up in the mid to high 1400s, new high for this cycle. That will, however, require the stars to align up perfectly. So I think depending on what sort of positive news, if any, we get out of those areas, you know, certainly sort of another 50 S&P points from here, perhaps another 100 and a bit, but that, I think, would be the extreme.
So, Bob, when people hear you talk about the S&P 500 hitting a new high for this cycle, they wonder to themselves, why do they call you Bob the Bear? You haven't in any way dropped your long-term view, right? This is just short-term tactical asset allocation. You're still thinking S&P 500 in the 800 to 850 neighborhood sometime late this year, early 2013?
Yeah, look, nothing long-term has changed. It's just tactical. I think, you know, if you sort of had the calls that I had in 06, 07, 08, and if you look the way I do, the term bear sort of sticks quite easily. But I think for me, tactically, there can be up and down moves. I think the secular view still is very negative. Too much debt in the world, not enough growth, and the policymaker solutions to our problems have been, we think, pretty much all wrong.
So, Bob, over the next several months, why is it difficult? Why do you find it difficult to have more conviction? Is it because of what we discussed the last time around, this idea that there's sort of central banking anarchy, and that it's very, very difficult to predict what, say, the ECB or the Fed might do next?
Yeah, look, I think policymakers, I'm not going to say they're making it up as they go along, but Eric, you yourself would have heard, the whole world would have heard a bunch of European politicians telling us, for example, that the Eurozone problem was fixed. That was only a few weeks ago. And now we're talking about the extreme opposite. The issue here is that the underlying growth picture globally is deteriorating in China, in the US, in Europe. That's the big master clock. I think overlaid on top of that is the uncertainty around policy. And as I say, my risk on call over the next 2 months is driven by expectations of a lot of policy. The less we get relative to my expectations, the worse it'll be. And if we get, for example, a combination of very negative news out of Greece, nothing from the Fed, and pretty much nothing from the ECB, my risk-on forecast will be wrong. Let's see. As I say, I think it will be choppy. But I think for now, yes, the uncertainty, but behind all of that, the master clock is deteriorating.
Bob, one of the recommendations of yours that caught my eye is this idea that you should be buying protection against German bunds, long CDS effectively. How come?
Well, look, this is where we make a distinction between bunds. We also have the same view for the UK. Gilts and bunds as cash bonds can remain pretty special. For example, in Europe, the bund is the only really sort of viable type of collateral left. So from that perspective, bunds and gilts can remain special and at low yields. However, what the CDS market does, I think, better than just outright government bond markets is to price in credit risk. And in the case of Germany, it's pretty clear to me, to my colleagues Kevin and Andy, that either way, Germany is paying. Germany's either going to pay if there's a sudden unilateral default. The losses it will face on Target 2 will be enormous. Germany's either going to also pay through fiscal union, if we end up down that way, which I think we will eventually, Germany's going to pay through running much higher inflation than the periphery. It's pretty clear we can't make the periphery any more competitive, so therefore we must make Germany less competitive, is I think the part of the solution. And in all three scenarios, I think bonds sell off more in the last scenario, but I think CDS can perform pretty well in all three scenarios.
So, Bob, if that were to continue happening, and if your view were to play out that Germany effectively, the market prices in greater credit risk for Germany, would we not see money flow back into Treasuries? You were long Treasuries. You took that trade-off a couple of weeks ago, excuse me. Would you put it back on?
Yeah. Yeah, look, I mean, again, here's the distinction between the tactical and the sort of much longer-term strategic call. I'm generally, as you know, Eric, for the last few years been a bond bull. I think the problem for me is identifying the core bond markets. Germany, the Bund still remains pretty special, but over time, the Bund will become more of a credit risk than it has been. My estimation is that the Eurozone roughly is a low single A type of credit risk. And if Germany ends up being the guarantor of all of this, you can figure out what that should do to bonds and the credit risk of Germany. I think in the US and the UK, where we don't talk so much about credit risk, my concern longer term is that if the growth picture remains very negative in the UK perhaps, and also deteriorates in the US wrapped around the fiscal crisis, yeah, bonds are attractive and the natural reaction is a flight to quality, to safe havens like the dollar, like Treasuries. But at some point, and I don't think we're there now, but at some point we'll start to price in credit risk in the US as well, and in the UK for that matter. Let's see. I think longer term this is going to be the story.
We might have to wait for that one, but in the meantime, Bob, we'll see if Standard & Poor's and Moody's catch up with you on the credit rating. Germany, a low single-digit A credit. And good to see you this morning. Bob Janjuah of Nomura, he's Global Head of Tactical Asset Allocation, says we could be on for a risk-on trade for the next couple of months, maybe see the S&P 500 back into the 1400s.